Howdy, Jacob here. Today we're going to do a more in-depth analysis on Magic Software Enterprises. Just a reminder that everything I say will be of my opinion, and if you agree, disagree, that's great. Just please remember that this is meant to be reviewed in conjunction with your own analysis. This is not meant to be the final straw or anything. The whole goal of everything I'm doing is to try to show you a little bit of what I look at and is not meant to be final say and just buy it or not buy it depending on the present value of the company that I'm getting from earnings and cash flow. So please keep that in mind. But let's remind ourselves about the company a little bit. So we see that they have a $527 million market cap on $477 million enterprise value. Looks like their net debt negative in the fact that they have more cash on hand than debt, which is great to see. They're in the software industry. They were founded back in 1983. They're based out of Israel, and then growth is absolutely insane. In 2013, revenue was 145 million. In 2022, it's up to 567 million. Margins, a negative story though. Gross margin was 40.7% in 2013, down to 27.4% in 2022. Similar story on operating margin, 13.2% 2013, down to 10.7% in 2022. Makes their current dividend yield of 6.2% is pretty big, and that payout of 25 million is roughly 60% on a 5-year average basis of their free cash flow. They have very low capital expenditures, so that's great to see. The use of cash is probably 50-50 on making acquisitions and paying out a dividend. Their return on invested capital is high single digits, so it makes sense why they're paying a dividend because their return on invested capital isn't absolutely huge. But now let's get into some of the notes that I wrote down for the company. So they're a global provider of IT consulting services based out of Israel. Like I said, they do have quarterly reports, but they don't have 10Qs, 10Ks. They have 20F because they're a foreign company. Their CEO's statement in the quarterly reports was pretty generic, and I pulled one of them. I pulled a quote from one of them. We remain committed to executing our strategy to build a broad portfolio of software products and services that create value for our customers in managing, streamlining, accelerating, and maximizing their businesses. So pretty generic. The margin decline is definitely a little bit of a concern here, but this is the dividend yield screener. They've been paying a dividend since September of 2012, so that's very positive to see. And they've actually increased it quite a bit since they started. So it was 21 cents back in 2013, and it's now as high as 51 cents in 2022. That's great to see. They have a low single digit growth year over year in 2023 from their quarterly statement. And then in their most recent quarterly report, we see that there was an increase in both short-term and long-term loans, but their cash and cash equivalents on their balance sheet is still greater than their total short-term and long-term debt. So the balance sheet, although that they increased their debt, their balance sheet is still absolutely fantastic in the sense that they have more cash on hand than debt. So if they really want to do, they can just pay it all off now. So that's no concern there. Pointing out that their two largest clients account for roughly 21% of revenues, with their top 5 clients making up 26% of revenues. That's not very much, so that's great to see that they're not too centralized and too focused on one or two clients. Obviously, if both clients left, a 21% hit on revenue would be huge, but it's good to see that they're not so centralized that they're just relying on one cow to do the milking. They have roughly 54% from a geographical revenue standpoint. 54% revenue come from U.S., 36% Israel, and then 10% elsewhere. And they do serve in over 50 countries, so that's pretty crazy. Their board stated they contribute up to 75% of their net income to dividend since 2017. So they have been really focused on paying the dividend, and they're willing to pay up to 75% of their dividend out of netting 75% of net income out to dividend to shareholders. The thing that is interesting about this, though, is that they really don't buy back shares. And just from a capital allocation standpoint, if the company's really doing their absolute best capital allocation standpoint, they do they should be able to buy back shares when the company gets stupendously cheap. Which, if it gets stupendously cheap, their use of it, their capital allocation towards dividend is less important than buying back shares that could yield in excess of 15% return. Whereas a dividend, you're just getting it, sending it back to the people. They're going to make 7 to 10%. So that return invested is not super great. So if the shares get stupidly cheap, we would want this company from a capital allocation standpoint to buy back shares. But again, this is also a dividend yield, so we don't necessarily care as much about perfect capital allocation. We just want a company that pays a dividend in excess of 4% dividend yield that is a good company and has a good balance sheet and everything. And right now, great balance sheet and just outside of the margins and growth through acquisitions, it's a very positive story here. And then last thing, before I get into something else, uh, their consulting services. This is their 20F, so this is 22 versus 21. Grew the most, but has the lowest gross margin. So keep that in mind. But their insider ownership is what I like to see for companies that are pretty small, and this is just over a $500 million market cap at $527 million. And so I want to see a good amount of insider ownership, and we actually see that Formula Systems owns approximately 46% of shares. And the cool thing is that Guy Bernstein, the CEO, is also the CEO of Formula Systems, owns 11.7%. So that's owns 11% of Formula Systems. And so good insider ownership here. It's good to see that the CEO is not just talking the talk, but is walking the walk. He's going to hopefully there's a better chance that he does what's best for the business being an owner of the company with as many shares outstanding as he does. So that's a very positive sign, especially for smaller companies. You want to see as high insider ownership as possible, because then you can feel more confident and relieved that the company's board and insiders are going to do what's best for the shareholder. And so, final assumptions here. I kind of just brought down revenue change because they've just been going so crazy right now through acquisitions, and um, seeing that they're paying out as much as 75% of net income to dividend, I feel like they're telling me that they're not going to grow as much in the future, and they've been growing so much recently that I'm just skeptical that it's going to be double digit forever. So that's just me being conservative. And then I opened up the range of margin because again, their margins are declining. So obviously, you can see that this is at the end of 7 years. They haven't been as low as 5% and as low as 8%, but their margins on gross and operating have been going down over the last 10 years pretty consistently. So I brought I brought the margins down, saying that they're going to make some acquisitions, and their margins aren't going to be margins of those acquisition businesses are going to be possibly lower. And then due to lowering growth, I lowered the PE, price free cash flow, at the end of the 7 year period. I kept the dividend increase the same, saying that it's going to increase 3% a year. I think that's very fine. Although margins might go down, their revenue's going up well above that 3% in my assumption setting. So payout should still be consistent in that maybe 50-60% range. And we get to a price that needs to fall 27%. To me, I mean, if you're looking for a company that um, needs dividend, is paying out a good dividend, we're seeing that. We're seeing the company is growing. We're seeing that their dividend has a good chance of growing and a healthy balance sheet. So as long as you buy it at a price that makes sense to you, I think this would be a great stock to add to your dividend portfolio. Again, just do your own research, get it at a price that makes sense to you, but definitely looks like a company that's going to be great in a dividend yield portfolio. So thank you and have a great rest of your day.